IAS 19 employee benefits are tested quite frequently in conjunction with the statement of cash flow. So let's have a look at what we need to pay attention to. So to begin with, we are going to look at the opening balance and the closing balance because these are going to be the opening and ending part of our role. So our opening balance is 12,320 and closing balance is 14,750. Let's have a look at why we had this change and think about where these items lie in our statement of cash flows. So first of all, we had current service cost and past service cost. Both of them are going to be recorded in P&L. Both of them are going to increase our liability. Since by default our pension plan is in liability, then we're going to put those numbers with a positive sign. We are talking about liability here. So basically the entry is going to increase P&L expense, and like debit current service cost, debit past service cost. And for the statement of financial position, it's going to be a liability. So it's going to be liability and liability. But these two figures, despite the fact that they form operating profit, have nothing to do with cash flows because these are just P&L items. So this means that we need to take service cost for pension plans and we need to add them back. So both 430 and 70. And afterwards, we need to double check whether the sign is correct because it's so easy to make a mistake here. These are going to be the adjustment to the in expense so that we would add it back. So the sign is supposed to be positive. Then we have interest. Interest is going to increase our opening balance. So we take the opening balance, we times it by 5%, and this is going to be our finance cost. So finance cost is an expense in P&L, and it's going to be a liability increase in statement of financial position. But it has nothing to do with the statement of cash flows because as it was not a part of operating activity, operating profit, we don't need to make any adjustments. As it is non-cash, we don't need to deduct it as a cash flow. What we need to deduct as a cash flow is contributions paid to the pension plan. Those contributions that have been paid to the pension plan are going to be a cash outflow. So we don't touch P&L, we are going to reduce a liability and it's going to be a cash outflow.
Cash flow statement, pension plans are overwhelming and there are so many SBR topics like that. And that's why I have a fantastic revision course that will revise the most important standards like leases, like consolidation, change in group structure. And it's going to tell you how the standards can actually be tested. It will help you to develop the skill that you might be lacking and as such not earning the marks that you deserve. So follow the link in the description, enroll to my revision course and pass this session.
So we are going to go to our operating part of our cash flow statement and we're going to record contributions paid to the plan with the minus sign because that was an outflow. Then we have benefits paid out. This has nothing to do with the company at all because this is the settlement between the pension plan and the employees. So it doesn't go anywhere in statement of financial position, in P&L or cash flow statement because this is not our problem. And that is it. So theoretically, we were supposed to get a liability of 12,636. But our closing balance is different. It's 14,750. And the difference is going to be the remeasurement component. Remeasurement component means that things have changed. So for example, life expectancy has increased. Or for example, our expectation as for the return of the assets that the plan holds has changed. Remeasurement component will go to OCI, and it can be a gain or it can be a loss. In our case, it's going to be a loss because a liability has increased. So if liability has increased, it's bad for us. And as such, it's going to be OCI, it's going to be statement of financial position, it's going to increase the liability. Now, let's double check what is going to happen with our statement of cash flows. Current service cost and past service cost are going to be added back. Why? Because they reduced operating profit in P&L, and now we need to add back because they are non-cash. Finance cost is going to be ignored since it wasn't in operating profit. And contributions to the plan are going to be our cash outflow, and remeasurement component also is going to be ignored since it was not part of the operating profit that we are adjusting as part of our statement of cash flows calculation. And that is how it works.